Alrighty, everybody. Good afternoon. I am Jessica McClellan. I am the Practice Growth Manager here at William Vaughan Company, and I'm going to be your moderator today for the webinar Business After COVID-19, PPP Loan Forgiveness and Recovery Best Practices. Before we begin, a few housekeeping items. We'd like to ask that everyone mute their lines if not already done so, and if you can, please turn off your cameras so we can reduce the amount of noise that we have. Everyone should be in a listen-only mode. There will be a question and answer session at the end of the presentation, and if you'd like to ask a question, there is a Zoom group chat in the bottom right-hand corner that you can go ahead and use that to ask questions and submit to the panel, which we will take at the end of the session. Also, I'd like to note that we will be providing a recording of today's session following the ending of the webinar, and that should be out either today or tomorrow. So let's begin. As government lockdowns are being lifted everywhere, business owners are shifting their focus to the restart of their operations. Understanding PPP loan forgiveness, how to maximize it, the best practices, and more recently, the Flexibility Act are all top of mind. So with us today, we wanted to provide you the latest guidance, the best practices, and answer some of your questions. Today with us, we have a stellar panel, which includes Kate Matz, who is a partner at William Vaughan Company and is the firm's advisory service practice leader. We have Mike Hanf, a partner in our tax department. And we have Sandy Towns, who is also a partner and the co-leader of the firm's tax practice area. I really hope you enjoyed today's presentation. Kate, the floor is all yours. I think we're having some technical difficulty. 1 second, folks. Sorry about that. Go ahead, Kate. The floor is all yours.
All right. Looks like we got the mute turned off now. So actually, Mike is going to start out, and he is going to talk about the significant changes that are coming out of the Flexibility Act that was just passed last night. Then I'll hop in.
Awesome. Well, thank you, everybody, and sorry for that, I guess, technical difficulty there. Hopefully everybody can hear me okay now. Thank you for joining us. Hopefully we can answer some of your questions today. As everybody is aware that this PPP loan and specifically the forgiveness just continues to change. And so we're trying to stay as on top of it as possible. As we've gone through the slide deck, we have updated the slide deck for the changes that just happened yesterday. But for purposes of maybe kind of summarizing some of the more significant changes, we just wanted to start off really by kind of summarizing some of these changes. So it's a bill that started in the House. The House approved last week. The Senate passed it yesterday. So it is still waiting for the President's approval. So this is not final law yet. It is expected that the President is going to sign it. So we've gone ahead and updated the slides. So previous to the Flexibility Act, there was a 75% payroll requirement. So of the forgiveness amount, no more could be for the non-payroll costs. 75-25 allocation. However, as previously written, it was okay if you had a 100% payroll, 0% non-employee cost. It was just okay to have other percentages as long as you met no more than 25% was non-payroll costs. That's why we say the 75% payroll requirement. They reduced the 75 to 60%. Actually, inadvertently, they also changed the verbiage. And so the 60%, the reason we have cliff there, if you received $1 million in PPP loan money, just in total, the 75% rule really related to your forgiveness. So if you only spent $500,000 and you were only kind of eligible for forgiveness of $500,000, then 75% of that $500,000 had to be spent on payroll cost. The way it's now worded is 60% of your PPP loan must be spent on payroll cost. So the potential, we're just waiting for some FAQs on this, but the potential is it really is a cliff. If you got $1 million and do not spend $600,000 on payroll cost, if you spend $550,000 on payroll cost, you will not have $550,000 forgiven. You'll have zero forgiven. So that's kind of how it currently reads. That's more of a literal interpretation. I don't think that's really what the intent was. So we're waiting for some kind of clarification, but just wanted to bring that to everybody's attention that it's kind of a, I guess, potential big deal that if we don't spend 60%, not of just the forgiveness, but 60% of the total loan on payroll cost, potentially we're going to get $0 of the PPP loan forgiven. The second change, and this is a huge change, right? This is great for everybody. So the 8 weeks is now 24 weeks. So where we had 8 weeks to spend the money for it to be forgiven, we now have 24 weeks. So all the same rules within that time period, and Kate will go over kind of some slides that help us understand what's included in the 24 weeks. But so the 8 weeks is now 24. There was also a couple of safe harbor rules. We have a couple of slides on that essentially allowed companies to restore both the kind of rate of pay, so the wages, in addition to the FTEs. So it allowed them to restore the wage rate and the FTEs by June 30th to eliminate any of the reduction in the forgiveness amount. That June 30th amount has been changed to 12/31. So you just get to restore them at any point during 2020 to avoid the reduction for the wage rate or the FTE. There's also some rehiring leeway for safety standards. So in reading through that, it appears as though kind of one of the practical applications is, let's say that we own a restaurant and we simply can't hire everybody back because we're forced to operate at 50% capacity. We haven't really seen how the math is going to work yet, but based upon the words, that restaurant should not be penalized for an FTE reduction because they can only hire 50% of their staff back. So that's kind of that safety leeway that is in there. For the amounts that are in the PPP loan that are not forgiven, it used to be a 2-year 1% loan. That 2 years has been increased to 5 years. So still 1%, but a 5-year 1% loan. The last item here, and this gets a little confusing, but so originally there's this payroll deferral. So the employer portion of Social Security were allowed to not remit to the IRS, hold on to just that employer portion of the Social Security, and hold on to that all the way through 12/31/2020, and then repay that, half of it, 12/31/2021, and half of that 12/31/2022. But originally it was thought to say, well, we can't do that payroll tax deferral and the PPP loan at the same time. So that's kind of version 1.0 of the understanding. Version 2.0 of that understanding was, no, we actually can do both. We can apply for the PPP loan. We can begin to defer our Social Security, just the employer portion. And essentially we can apply for the PPP loan. We can receive the loan. We can submit our forgiveness calculation to the bank. And we can continue to defer our Social Security payroll taxes up until the point that we got word back from the bank that we were approved for any portion of forgiveness. So then we had to shut that off. What the Flexibility Act does is this notion of once we hear back from the bank that we have to shut off that payroll tax deferral, it takes that away. So regardless of getting part of the PPP loan forgiven, we get to continue to defer that the Social Security, the employer portion, through 12/31/2020, and then pay half of that 2021, half of that 2022. So those are the changes. Again, we've got this throughout the slides, just wanted to summarize them for everybody.
All right, well, thanks, Mike, for walking through those significant changes. I'm going to go through now kind of the basics of forgiveness and how it works. And as Mike said, I'll be including in here the most recent changes as well, but this is going to kind of back us up a little bit and just talk through how exactly are these things getting calculated, and go into a little bit of detail on what's included in some of the line items. So when you look at the forgiveness calculation, there's really a three-step process. Lots of intricacies to each of those steps, but we've kind of boiled it down to 3 steps for presentation purposes here. So first step is you look at all of your payroll costs, add in the eligible non-payroll costs, sum those up, and you get the total eligible cost. So we'll talk a little bit more about what's included in the payroll and eligible non-payroll in a couple more slides. But for right now, step 1 is add up your payroll costs, your eligible non-payroll costs, and you come up to the total eligible cost. Step 2 then, you start looking at some potential reductions that you might have to take into account to those eligible costs. So the first area is to look at payroll, and what used to be dividing by 75% to come up with the payroll 75% requirement that now has been moved down to 60%. So payroll divided by 60% gets you this payroll 60% requirement. And as Mike talked through and as noted on the slide here, we think based on the current reading of the language that was just passed in the Senate last night, that it is a cliff, whereas before 75 was the amount that you needed to achieve in order to obtain figures, is that you need to obtain at least 60% usage of the loan in payroll costs to obtain any forgiveness. So this will be an area to kind of continue to watch and see if some additional guidance and clarification comes out. Changing that, I think that is going to be a cliff. The second part of step 2 then is to look at the total eligible cost and subtract out any potential wage reductions or FTE reductions to come up with a modified potential forgiveness. So wage reductions would be if you've actually reduced the rate of pay. You actually have a lower workforce during your covered period. So step 3 then is you look at the lesser of 3 amounts. So the payroll 60% requirement, which you calculated out in step 2, the PPP loan amount, and then the modified potential forgiveness that you also calculated in step 2. So it's going to be the lesser of those 3. Again, we now have this kind of potential for this cliff in the payroll 60% requirement, which could throw a little bit of a wrench into things. But basically what this is saying is, hey, you're capped at the amount of your PPP loan amount. You can't get more forgiven than what you actually got. You've got to make sure that you're spending the majority of it on payroll, and now that's at least 60%. You also have to take into account if you had reductions in wages or FTEs, and if so, you're going to get dinged a little bit for those as well. So let's dive into some of the details now on exactly what's included in some of these items. So if we move over to payroll and take a look at that, you can use either the covered period or an alternative payroll covered period to look at payroll. So covered period now means the 24 weeks that starts on the day that you received your loan and goes out that next 24 weeks. Alternative payroll covered period is a relatively new concept that was introduced just a couple of weeks ago when the SBA and Treasury released the application for forgiveness. And what this allows you to do is shift the covered period for your payroll cost only, so that it will begin on the first day of the first payroll period that you have starting after you receive your loan. So previously, up until last night, that looked like that may be significant, that it may actually allow you to include some additional payroll costs in that covered period. Now that the 8 weeks is going out to 24, it's still an option, but it appears that it's going to be just a little bit more for administrative ease of being able to track your payroll costs and having those line up with your specific payroll periods, as opposed to a strategy for including additional costs. Unless maybe you're in an industry that does have a prolonged period of time where you're shut down, then you still might be looking to pull in some additional cost. But you've got those 2 options on the payroll. Another item on payroll is that there is a limit per person of $100,000 annual compensation. So when you look at the 24-week period, this means that for each individual employee, the amount of their compensation, their cash compensation that you're going to be able to include in the forgiveness calculation works out to about $46,154. So that's just the pro rata amount of that $100,000 annualized limit taken down to the 24-week period. Payroll is calculated off of gross pay. So still a little bit of confusion with some folks on if it's gross or net and what you do with some of the taxes or other withholdings. It is gross pay. So start out with that gross pay that you're paying to your employees, and then you get to add in the company paid health insurance and company retirement contributions on top of that. In addition, any state unemployment taxes that you paid during that time period you can include as well. One item of note here is that unfortunately for owner employees, so if you are self-employed or if you are in a partnership and you're an owner, you unfortunately are not able to count the non-cash compensation for forgiveness. So any health insurance premiums that the company is paying on your behalf or retirement contributions the company is making for you is not included in the forgiveness calculation. Only those W-2 wages that you are receiving can count, or if you're a Schedule C, only that amount that is the net income from the business would be able to count. All right, so that's payroll. Let's shift down now and talk about the eligible non-payroll cost and what's included there. So this is just the covered period. You don't have an alternate period that you can use here. So covered period, again, will begin on the date that you receive your loan funds and go out for the next 24 weeks. This would include mortgage interest on both real and personal property, rent on both real and personal property, and then utilities that you would have paid during that period. In all of those cases, these agreements must be in place prior to February 15th of 2020. The rationale for that is the loan funds being provided here are really intended to allow businesses to continue to operate as normally as possible. Nothing seems normal right now, but to allow companies to continue ongoing operations as close to normally as possible. The purpose is not to provide companies with additional funding to go out and make investments or make additional capital expenditures. So this is really just to say, hey, if anything was in place prior to the beginning of the COVID crisis, 2/15 is the date that they kind of drew the line in the sand there. So anything prior to that, we want to be able to help companies to continue to pay those costs. All right, so then if we start talking about some of these potential reductions, a little bit more detail here. So the wage reduction. You have any folks that you reduced wages more than 25%, you're going to look at having to take a potential wage reduction. So you're going to look at the compensation during your covered period, what that average rate is, compare that back to what the compensation rate was for the first quarter of 2020. And if you have a reduction of 25% or more than 25% in that covered period, you kind of meet the first criteria for potentially needing to take a reduction here for wages. One item of note is that if you do have any employees that made over $100,000 in 2019, you can exclude them from the calculation. And the way they've defined this is a little bit differently than what you might think. It'd be easy if you just kind of looked at the 2019 W-2 to see if anybody was over $100,000 and threw them out. But instead, what the requirement is here, and it's actually a little bit more administration, but actually could be more favorable for you, is that you look at the wages that you paid in each pay period in 2019, and if any one of those, when you annualize that out, is over $100,000, you can exclude them from this calculation. So that means if you had somebody that made less than $100,000 in 2019, but they were paid a significant bonus in a given pay period, if you take that bonus pay period annualize that, and that's over $100,000, you can exclude them from. Last item on here to note is the safe harbor. And Mike hit on that at the beginning as far as one of the changes that just happened. And what this is saying is if you kind of do that step one where you do that comparison of covered period to that first quarter amount and you reach that greater than 25% reduction, then you look at step two and see if you meet the safe harbor. So the safe harbor says that if you had a reduction in the wage rates between February 15th and April 26th, as long as you restore those rates by the end of the year, so 12/31/2020, you do not need to take a reduction for these wages. So that was previously 6/30, just moved out to 12/31. Again, assuming that this is all signed by the president, which we think it will be. So lots of time here to be able to get those folks back up to the wage as of 2/15. All right, next potential reduction to think about then is the FTE reduction. So FTE stands for full-time equivalent, and that is based off of a 40-hour work week. So anybody that works on average 40 hours or more per week is going to be 1 FTE. Anybody that works on average something less than 40 hours per week, you're going to take whatever that average is, divide it by 40, and that's going to be the fraction of a full-time equivalent that you'll include for that individual. So again, you're going to look at what your FTEs are during your covered period. You're going to compare that back to a prior base period, and there are several options here as far as what to use for a base period. So it really makes sense to kind of run through the numbers and see which one is going to be most beneficial for you. But if you have a reduction of FTEs in your covered period to whatever base period you choose to use, you're going to take a proportionate reduction to the amount that you have forgiven. Again, though, you do get to move on to that step two and look at if you can meet that safe harbor. So that safe harbor, same thing as what we talked about on the compensation reduction. You're going to look at if you had any reductions in FTEs between February 15th and April 26th. And if you did, and you restored them back to that February 15th level by the end of the year, so by 12/31, then you will have no reduction for FTEs. All right, I am going to turn it back over then to Mike to talk about some best practices.
Thanks, Kate. Appreciate that. So we've had this slide here in some previous presentations, and very candidly, when it was 8 weeks, I think trying to maximize forgiveness was a focus of everybody's. Now that it's 24 weeks, I do think there's certainly circumstances out there within certain industries where even within 24 weeks, it might be difficult. We're hoping that for the lion's share of folks that got PPP funds, that the 8 to 24 weeks really makes maximizing the forgiveness, getting complete forgiveness, easy. So I do still want to run through some of these items here that we were thinking about, just in case, even within 24 weeks, you feel like getting 100% of the PPP loan forgiven is going to be difficult. The first item, and there is a little bit of disagreement amongst professional organizations out there, just to kind of make you aware of. Our interpretation of the instructions would basically say that the payroll costs that are paid within the 24-week period are eligible for forgiveness. Also, payroll costs that are incurred but then paid on that next payroll cycle are eligible for forgiveness. There's verbiage in the instructions that say you can't count the same cost twice, but kind of visually, we're kind of thinking of these as two buckets of cost. All the costs that are paid during the period, in addition to all those costs that were incurred during the period, versus costs that, like, each cost has to be paid and incurred in the period. We're thinking of it as two separate buckets. So what does that mean from a forgiveness calculation? We believe if a company pays bonuses for the prior year's performance, so by the time we get 2019, books and records closed, maybe even because of COVID-19, it just took a while to close the books. We came up with, okay, we're going to give everybody a bonus, and we happened to pay that bonus out that was really incurred, right? It was earned during 2019, but we're paying that bonus out during the 24-week period. we believe that that bonus is going to count towards your forgiveness. Because even though it wasn't incurred during that 24-week period of time, it was paid during that 24-week period of time. So also bonuses and hazard pay. So at one point, people were kind of worried that you couldn't like increase. If somebody typically made $5,000 a month, then you couldn't give them some extra hazard pay or give them a bonus during the covered period to increase your forgiveness. The interim final rules that came on actually with the applications really cleared this up, that does count. If you increase somebody's pay during the covered period, if you give them a bonus during the covered period, that will increase what the forgiveness is. Profit sharing contributions. This one gets a little bit out there because you could essentially pay like all the profit sharing contributions for 2020, like during this 24-week period of time. We're kind of suspicious that by the time we get to the finish line, they could have some FAQ or some interim final rule that somehow restrains how much we can pay as far as like profit sharing contributions. But as the law is written right now, any amounts that are actually paid to the employee would count. So if we feel like we're going to fall short, you might want to think about kind of increasing some of those profit sharing contributions, just the cash being paid within that period of time. I guess catch up rent. So if we've been allowed by the landlord to not pay rent for several months, but we're obligated to kind of catch that up, we would encourage you to catch that up during that 24-week period of time. We still have to kind of manage that 60% ratio. So we need to make sure we're paying or spending at least 60% on payroll costs. This would be a non-payroll cost. But it's our interpretation that rents paid during the 24 weeks are going to count, even if that rent was incurred prior to the I guess 24-week covered period. Now on the back end, it does not kind of limit the prepayment of rent. So if you have rent that is on the back end of the 24 weeks that you simply pay 2 weeks after your 24 weeks is over, as long as that payment 2 weeks after is in that normal cadence. You always pay the rent on June 20th, or I guess this would be August 20th or something. So if you always pay it on the 20th of the month, as long as you pay it within that next normal cycle, you're going to get to include that within the 24 weeks. But also, if you wanted to be uber conservative, you could go ahead and prepay a couple months within that 24 weeks. We don't see where that is being limited out, other than still meeting that 60% threshold. For the instructions, it does specifically state that prepaid interest will not be allowed. So it doesn't say that for the rent, but it does say that for the interest. Also, we're really encouraging everybody that as we're going through all this, maintaining really good books and records of the assumptions that we've made and really being transparent with the bank as far as the assumptions that we've made. So we're really enlisting the help of the bank also as we're getting SBA approval for the forgiveness, that we're not subject to kind of some sort of surprise under an SBA audit. We're really encouraging everybody to maintain really great documentation of all the assumptions and all the numbers that have gone into that, and be really transparent with the bank just so there's no surprises on the back end. One item we don't really have on the slide, but just kind of, as I mentioned, kind of audited by the SBA, if you have over $2 million of PPP loans, then the word is it's going to be an automatic audit. Really not exactly sure how thorough, detailed the audit's going to be, but if you're over $2 million, it's going to be an automatic audit. That's not to say that under $2 million, you're not going to be audited. It's just under $2 million is going to be more of a random audit versus if it's over $2 million, it's going to be an automatic audit. So just wanted to kind of point out a couple of tax considerations here. We don't believe this was the intent within the original law, but SBA and Treasury have come forward to say expenses, including the forgiveness calculations, are not tax deductible. So if we got $1 million PPP loan and we spent the full $1 million on payroll cost, and we get the full $1 million excluded, or we don't have to pay it back. So that forgiveness is not going to be income on our tax return, which is good news. But those $1 million of payroll costs are also not going to be tax deductible on our return either. So it's a bit of a net wash, right? So we could have included the forgiveness income, included the payroll expense, come down to a net zero. when they put this in, they really just kind of brought it back to a net zero. So the expenses that are related to the forgiveness are not going to be included in our 2020 tax return. The deferral of the employer Social Security taxes that is now allowed all the way to 12/31/2020, regardless if you have anything forgiven. That is assuming that the president signs the Flexibility Act. We just want to throw out there, for whatever reason, there's somebody on the call that didn't get a PPP loan, doesn't want to get a PPP loan. There is something to be looked at as far as this employee retention credit. So essentially, it can result in a $5,000 tax credit per employee. It's 50% of the wages from March 12, 2020 through 1/1/2021. If you want to go down that road, there's some modeling that you really should do for that. So just feel free to give any of us a call, and we'll kind of walk you through it. It's a pretty involved calculation to kind of see if that works. So just want to bring that to everybody's attention. There is something else out there just besides the PPP loan. So as far as next steps, we do have our WVC calculator. We've got a link here. If you just go to our website, if you go to the COVID-19 resource page, you'll see the link there too. We are updating it for what just happened last night. So if you have a previous version, it is on the old rules. We are in the process of updating it. And in fact, it's already been updated for the new rules. It's just going through some of our internal quality control checks. So hopefully we will have that out soon. So when I think about the what should I do next, get your hands on our calculator and drop the numbers in there and see what it looks like. And if you're under the 24-week scenario, if you're really comfortable that 100% of the loan is going to be forgiven, making sure to pay close attention to how the wage reduction calculation works, also the FTE calculation, making sure to pay really close attention there, because even if you spend all the dollars, if you have a wage reduction and or a FTE reduction, you can still get surprised at the end. But my recommendation is really thoroughly model this out. We'll certainly be happy to help with that also, but make sure to really thoroughly model that out. And so the calculator is going to help you do that. So once you can see what it looks like at the end, then we can reverse engineer. If there's some sort of bad answers at the end of 24 months, we can reverse engineer how to potentially get away from those, I guess, bad answers. So just use good business sense is something we've really been preaching. If a company didn't need to spend $100 and just spent $100 because they thought they had to for the forgiveness calculation, we would argue that spending $100 that you didn't have to spend isn't a good business idea. Not spending that $100 and having a 5-year 1% loan is still better, even though it might not be forgiven. Having a 5-year 1% loan is still better than simply spending money that the business wouldn't otherwise spend, right? Just not kind of good business sense. Get creative. Really, that kind of relates to taking that calculator. And if there are FTE reductions, if there are wage reductions, if we're not going to quite hit that 60%, well, then let's get really creative within the rules to do everything we can to eliminate those reductions or increase the amount paid on payroll within that 24-week period of time. If you really just don't like the idea of a 5-year 1% loan and you're not able to spend all the money, certainly it's always your option just to return the unused money. There's no prepayment penalty on these as PPP loans. And then our recommendation, we believe 1% is a pretty low interest rate. To the extent that we are not able to spend all the funds, and we've gotten as creative as we can, and we really maximize the amount forgiven, we would really recommend just holding onto that cash. And again, there's no prepayment penalties, so just the fact that we hold on to that cash maybe fourth quarter of 2020 doesn't mean that we needed to hold on to that cash for the full 5 years, but I would suggest at least holding it on for a year or so just to kind of see where things are going. So that's a couple of next steps for everybody. And I believe we're going to go to questions, and Sandy is going to moderate us through the questions.
Okay, thanks, Mike. Good afternoon, everybody. I have a couple of questions that I received before we started. One of them was in regards to the date that the loan was dispersed. My loan was funded on April 9th and then deposited into my checking account on April 16th. So what's considered my loan disbursement date? I would the loan disbursement date would be the day that the funds are available to you. So if they were not in your bank account until April 16th, then that's the day that your loan would be considered funded and the day that your covered period would begin. And then eligible non-payroll costs as it relates to personal property. Can you provide examples of real or personal property that would qualify for forgiveness? For example, would this apply to leased golf course maintenance equipment such as tractors or golf carts? It's going to apply to any of those types of leases that are formal written leases that were in place by February 15th of 2020. Anything like that it's going to apply to. So all of those would be includable. But again, that's part of non-payroll costs. It can't be any more than 40% of the total amount of your loan. Let's see, what happens if you successfully spend 100% of the loan on payroll in the 8 weeks covered period, but then have a reduction of FTEs a month or two later? Well, the FTE reduction restoration date is now 12/31/20, and that's just a hard and fast date. If you have people as of that date that restore your FTEs to where they should have been, then you're going to be good. The next, there's no requirement to keep those people for any period of time, which kind of seems like a loophole in the intention of the law. But that's how that would work.
There's one other item that I think might be relevant there, and so we've tried to read everything last night and kind of digest as much as we can. So I mean, certainly appreciate the fact that we probably haven't digested everything in the Flexibility Act, but it seemed to be that there was a section in there that allowed you to still submit your paperwork after the 8 weeks. It does not appear that you can choose a 10 or a 12 or a 16 week. It seems to be like an all or nothing, 8 week or 24 week. So I think in this scenario, if you feel really, really comfortable that you're going to get 100% of it forgiven, and you don't want to expand your covered period to 24 weeks because you might end up having a wage reduction or FTE in the kind of the weeks after that 8 week, it seems as though in the Flexibility Act there is that provision available for you, that you can still stick with the 8 weeks and just file all your paperwork within that, I guess using that 8 week as covered period. Seems to be that straightforward. I bet we're going to get some FAQs and some kind of clarification on that, but based upon the read last night and this morning, it seems like you can still stick with the 8 weeks.
I think that's correct. It's now an optional 8 or 24 weeks, but no options in between there.
Right.
In the calculator, I noticed that our average hourly wage rate is higher than their actual hourly rate because of the first quarter of 2020. We had a lot of overtime. Is there any adjustment that needs to be done so it doesn't look like we cut hourly wages? Kate,
I'll take that one. Yeah, so we were trying to automate that for you guys, and know that there's a lot of information to gather and plug in. It seems though that given overtime considerations or some differences in payroll periods, that works really, really well for some scenarios, but doesn't work so great for all scenarios. So in the most recent version of the calculator, that will not be a calculated field. That will just be something that you plug in. So you'll just plug in what the average rate was for each of those periods. And that will kind of take out any of those issues of overtime or differences in payroll periods. So.
Thank you. Are commissions paid to outside distributor reps and eligible payroll cost? Well, if this is something that you normally would issue them a 1099 for, then it would not be includable. The payroll cost, generally the definition is the same as it was when you applied for the loan. So whatever you included as payroll costs at that point would still be includable, and it's generally going to come back to W-2 employees. It can remain 75% correct. Yes, the 60% is a minimum. So it can be 75%, it can be 100%. The 60% is just a minimum.
I guess the point there to make sure to emphasize, if you got $1 million loan and you only spent 500,000 of it, then that 75% number related to the 500,000 that you spent. Now the 60% number appears to relate to the $1 million of the total loan, not just what you're running through your forgiveness calculator. So yes, it can be more than the 60%, but really that it's 60% of a different number now. is the way that the law reads. It's the total loan versus just what's eligible for the forgiveness.
If someone worked only a few weeks during the first quarter of 2020, when the calculator calculates their hourly rate, it's a lot lower than the actual because it's assuming these wages were earned over the 13 weeks. Does that relate to what you were talked about a minute ago, Kate?
Yep, yep,
That's been adjusted now, so you can put in whatever is the correct amount.
correct.
Does the cliff also apply to the FTE stipulation? For example, what if I spend 70% of the PPP funds on payroll, but I only bring back 80% of my workforce by the deadline? In other words, I only bring back 80 out of 100 employees. Well, those are different calculations. So the FTE calculation is not subject to a cliff. It's just the 60% that's subject to the cliff.
Yeah, so the FTE would be, in that case, if you had only restored it, or if you had 80% of your workforce during the covered period versus what you had prior to the covered period, you'd take those total costs that you had eligible for forgiveness and you'd reduce it proportionally. So that would actually go down from 100% to the 80% also. So it is a proportionate reduction unless you're able to bring them back by 12/31 of 2020 within that safe harbor, then you will not have a reduction.
There's actually 3 percentages that I think are tripping everybody up. What was 75 and is now 60 really relates to the portion that needs to be spent on payroll costs, right? We've talked about whether that's the forgiveness amount or whether that's the total PPP loan. Then secondly, as Kate just said, we've got this FTE calculation that does not have any sort of threshold to it. It is just a pure proportionate calculation that even if you have 99% of the people back, then you're gonna only have 99% of the amount forgiven. It's just a pure proportionate amount. The third one that I think trips people up is this wage reduction. So the wage reduction, you do not have a reduction in the forgiveness on $1 with the wage reduction. The wage has to be reduced by more than 25% to result in any sort of reduction. And then once it does exceed that 25%, it's not a percentage, it's a dollar for dollar amount of wage reduction in excess of that 25%. So there's 3 different calculations, 3 different percentages in there. My suggestion, really, that this is where the calculator is just going to help everybody. If you take the time to drop the numbers in the calculator will work through the math for all 3 of these calculations, and you'll really be able to kind of see it on the back end and see kind of the results within the math. So I can appreciate for everybody listening, it's like, we got 3 different calculations out here. We got all these different percentages. I mean, trying to keep everything straight without using a calculator like what we've created is really going to be very difficult.
And then there are several exceptions to the FTE calculation, which is what the next question is: how does someone retiring impact FTE? That's one of the exceptions if someone voluntarily leaves. That does not impact your FTE calculation. If you attempted to hire them back after you laid them off and they refused to come and you've got written documentation of that, then that does not in fact impact your FTE calculation. There was a couple of new ones added in the new bill. I think Mike mentioned that if you can only operate at 50%, so you can't hire everybody back, that's another exception to the FTE calculation. So there are several exceptions out there that you may fall under and not have to be impacted by that. Is workers' comp still includable as forgivable? Workers' comp is still included in insurance expense as an employee benefit, which would go into your non-payroll compensation calculation. Any amounts that were paid during the 24 weeks. Is workers' comp expense, including claims settlement, considered a payroll expense? I would think claim settlement would not be considered a payroll expense. It would just be the premiums. So what are your thoughts on that, Mike?
Well, I do know there's this payroll cost concept is somewhat vague. They've really tried to do everything they can to kind of clear that up. I guess I've got the loan forgiveness application in front of me, and as it says, it's kind of the where's the words I'm looking for? I mean, it's basically it's income. its expenses more like a SUTA, more like unemployment, where the unemployment insurance is really based upon the rate of pay. So one, definitely the claims are not included. And I think there even could be some banks out there challenging whether the workers' comp insurance itself could be included. What our recommendation has been, whenever there's kind of lack of clarity on something, go ahead, include it. Go ahead, be very transparent with the bank that you have included it, just to make sure that you're kind of getting the advice from the bank. But yeah, I actually think there's probably a strong argument to say that the workers' comp insurance premium itself was really not intended to be part of the payroll cost.
Somewhat related, sorry, I was going to add, if somebody's kind of thinking about workers' comp and then starting to think about, well, how does that mean, what does that mean for health insurance if I'm self-insured for health insurance? In that case, we'd say, yes, include whatever you need to pay for those self-insured health insurance costs. So any, stop loss amounts, any claims, administrative fees, all of those things that you need to pay to be, to continue to provide that self-insured health insurance benefit for your employees would count. It's specific to the workers' comp. There's more ambiguity around that, and I guess less agreement on whether that will be in or out.
The executive director of a nonprofit organization is not considered an owner, correct? No one owns a nonprofit organization. It belongs to the community. I would think that would be correct. Mike, have you seen any clarification on that?
So you're saying the question is, would the executive director be included as an owner?
Yeah, be considered an owner for the limitations that apply to owners.
And to be honest with you, I'm not sure that since the community owns it, the way that the law is written is that the 100,000 cap applies to owners, and they just would not be considered a owner. They don't get a K-1. None of the income passes through to them. They don't have risk of loss, if you will, for that entity. So I would not consider an executive director of a not-for-profit as an owner.
Right, that's what I would think as well. Line of credit interest is not eligible, correct? I think that's correct. Have you seen any clarification on that, Mike?
Yeah, this is one I really get kind of caught up on, because the instructions say that we have business mortgage interest payments during the covered period and any business mortgage obligation on real or personal property. So one, I'm not sure what they meant by mortgage interest on personal property, but that's just what they wrote in there, right? You tend to think of mortgage interest on real property. So mortgage interest on personal property. So we had the question earlier, clearly equipment, right? When we have equipment leases, and I think that applies to equipment that moves and equipment that is also installed. So certainly a transportation company and a bunch of trucks and trailers, but also for a manufacturing company and we lease the equipment that is within the plant. That seems to be very, very clear. It's this tie to personal property that seems to be a bit more nebulous as far as when you look at the underlying collateral for a line of credit. Well, typically it's a combination of inventory and accounts receivable. So we have one asset that is part of personal property, inventory, and another asset that's not part of personal property, accounts receivable. My hunch is that when all the dust settles, the banks are going to not allow interest on line of credits. So I want to kind of answer the question to say, no, line of credit interest is not included. But I do think there's an argument to be made there that say, well, wait a second, part of my line of credit interest is really attributable to my inventory balance, and inventory is a personal property. So why the heck wouldn't it be on that personal property? So great question. My suspicion is no, line of credits aren't going to be included. But if you are falling really, really, really short, I think you'd have a leg to stand on to take your line of credit interest and say my average AR balance is X, my average inventory balance is Y, and kind of take some proportion of that interest cost and include that in the forgiveness calculation and just have the bank tell you no. But I think you got a leg to stand on.
As you can see, there's still a lot of unanswered questions and not clear items. So
Yeah,
we're
a lot.
clarification, expecting more clarification from the SBA. In fact, I read that they had 20 or so FAQs ready to go, and we're just holding on to them to see what was going to happen with this bill in Congress. So maybe soon we'll be getting some more clarification.
So let's be honest, what they're waiting for is 11:30 Friday night, so they can ruin our weekend again.
Is the exclusion for those who made over $100,000 in 2019 just for the wage reduction calculations?
Yes.
It's for the wage reduction calculations, and there's also an exclusion for owners. They cannot include any owner's pay that's more than what they made in 2019, even if it's less than $100,000. Was the PPP forgiveness schedule that you sent out prior to the changes will be good to use? We'll be updating it. We will be updating it. And I assume that we're going to email everybody when it's updated so that it's available, that it's been updated and it's available. We'll send it out.
Yeah, we will with this. It's a big change. We'll send out a notification to anybody that has signed up for the WBC Insights. So if you aren't regularly getting communications from us and you would like those, if you go to our website and on the upper right hand side, there's a place where you can sign up for WBC Insights. That will get you on that list. So you will get those updates. In addition, if we've got minor changes that we're making to the calculator, we won't be sending out updates all the time with an email saying that those are there. So just do recommend that you're kind of going out and checking periodically to see what the latest is. We are date stamping at the top. So any minor changes, we won't flood your email inboxes with those notifications. But with this significant one, we certainly will be alerting people.
How are prepaid insurance expenses handled, workers' compensation paid in January for Q2 of 2020? I think we talked about prepaid expenses and workers' comp already. If we hit our 60% in payroll wages before the 24-week period, will we be able to close the loan out early? I think we talked about that too. You can use 8 weeks or you can use 24 weeks. And you don't have to wait until the end of the year to use all the money. That's just what your full period would be. Plenty expenses to be able to include to make sure that you have everything forgiven.
But it does appear as though if you go beyond the 8 weeks, then all these calculations then bump all the way up to 24 weeks, as far as the wage reduction, the FTE reduction, the different reductions you potentially have. Once you go beyond the 8 weeks, then it does go right to the 24. At least that's the way the law reads right now.
When do we apply for forgiveness? The new law actually puts out a time period of 10 months that you have to submit your forgiveness application to the bank. So you don't want to forget to do that.
So once it gets to the banks, then the banks have, they've got 60 days.
And they had 60.
Banks have 60 days to review your application and make their determination, submit that to the SBA. Then the SBA has an additional 90 days to decide if they want to take a look at anything and request additional information, or if they're going to go along with the bank's recommendation.
Sharing contributions. Go ahead.
I'm sorry, I just want to kind of point out something. If anybody out there is kind of thinking about this 8 versus 24, kind of a bit of a strategy, it's a bit silent as far as the electing the 8 versus the 24. So now that we have 10 months to submit our forgiveness, it would seem as though you could wait to the end of the 24, run all of your numbers under an 8-week scenario, and run all of your numbers under a 24-week scenario. And if the 8-week was better, well, then submit all your paperwork with the 8-week assumption. It's 8 or 24, but with this 10-month rule, it seems as though you could submit your paperwork for an 8-week forgiveness after the 24 weeks have already passed.
Do profit sharing contributions need to be in place prior to 2/15 like other arrangements in order to be forgiven? Unclear if a bank would look at bonuses starting during the PPP period and not consider that forgivable.
There was an interim final rule that the commentary by SBA and Treasury kind of after they kind of said the verbiage to say, hey, why are we allowing bonuses? Why are we allowing hazard pay? And it kind of had a bit of a commentary to say that they believe it's really kind of in line with what Congress was trying to do, right? We're we are trying to get more money out into the economy. So if you take that to its fullest extent, payroll paid during the 24 weeks really should be included. I think all this is subject to kind of last minute surprising FAQs and or interim final rules. But for a lease, it had to be in place as of February 15th for it to be included. Hazard pay, though, didn't have to be kind of a practice of that company. It didn't have to be in place as of February 15th for it to be included in the 8-week period prior, now the 24-week. So the way the law reads, we're really at liberty to, as long as we're giving money to our employees, our W-2 employees, we still have that $100,000 annualized limit that we always need to make sure we're kind of paying attention to, that just because we're giving them a bonus, we got to annualize that number to make sure we're staying underneath that $100,000 annualized threshold. It seems like we're at liberty to increase people's pay, give them rewards, hazard pay, bonuses within the 24 weeks, and that should be included in the 24-week forgiveness calculation.
Paying rent to one of our consolidated entities is ineligible, correct? Well, you could pay rent to a related party. There's a lot of business owners that have a separate entity that holds the real estate, and you can, as long as you have a written rental agreement in place before February 15th, you can pay rent to that related party and have it includable. You have recommended accounting, record loan and interest accruals now, even if expect forgiveness, and then record forgiveness following the audit. That is essentially what we would recommend. You record the expenses as you normally would record the expenses, leave the loan on the books as a loan until such time when you find out how much of it is forgiven, and then you would move the forgiven piece over to the income statement. Again, it's going to be non-taxable income, and the expenses are going to be non-deductible. They'll essentially net each other out once they get to the income statement. And one of the interesting things here is going to be what happens if this happens in different years. They're going to need to clarify what happens there. If these are all 2020 expenses and your loan's forgiven as of sometime in 2021, we'll have to hold up your 2019 financials and tax return until you know what amount to offset your expenses by. That's going to be something to be dealt with. Would lease agreements include semi-tractor and semi-trailer leases in place prior to 215 for a transportation company? I've seen that it only applies to individuals with PPP, independent contractors, and not companies, but I've also been told vehicle lease agreements do apply to corporations. I have not seen anything that says they would not apply to corporations.
Yeah, I think that lease agreements for semi-tractors and semi-trailer leases, at least as long as they were in place prior to 215, yes, that they would include under the rent for personal property.
Yep. When do you have to decide, 8 weeks or 24 weeks? Can you model both and then choose? I think that's what Mike was just talking about. There should be time after the end of the year that if you wanted to go back to the 8 weeks, you'd still have some time within your 10-month time frame.
And this is actually reading that within the Flexibility Act. An eligible recipient that received a covered loan before the date of enactment of the subsection, so basically the day that the president signs it would be the date of enactment, may elect for the covered period applicable to such covered loan to end on the date that is 8 weeks after the date of the origination of such covered loan. But then when it has the other changes down here, it does not provide any clarity as far as how the company would make that election. So kind of going back to what we were saying before, I think you have, at least how it's written right now, you have that 10-month window of time. So after the 8 weeks, you have 10 months to analyze the 8 versus 24.
In the FTE calculation, can you use 40 for full-time and 0.5 for all part-time employees, no matter how many hours the part-time people work? That is one of your options in the FTE calculation. You can either use a percentage for the part-time, they're 70% or they're 40%, or you can use 1 for the full-time and 0.5 for the part-time. That's one of your options. So, and our calculator makes it pretty easy to switch between the two of them to see which one works out better for you. Kate mentioned earlier that if wages are over $100,000, those are taken out of the calculation. Is that true? I thought it was only whatever's over the 100,000.
Oh, when I was talking about that, I was talking about when you are looking at your compensation reductions. So you can exclude anybody who made over $100,000 from that portion of the calculation where you're looking at, do you have any compensation reductions that you need to take? But you're absolutely correct. When you're adding up your total payroll cost, you will include amounts up to $100,000 per person. So again, this is where there's a lot of different calculations and percentages and numbers that you kind of have to work through. So yes, and the payroll cost, that first part of step one, include each individual up to the $100,000. When you get down later and you're looking at your potential reductions, when you're calculating out the compensation reduction, throw anybody out of that calculation who earned over $100,000.
Do we have to include the workers' comp Ohio premium refund in the payroll costs? Well, I think if the conclusion is that workers' comp insurance premiums don't count, then the premium refund doesn't count. And that's probably a better result for everyone in Ohio this year. Would the salary of an employee who is the 100% stockholder be handled?
Yeah, so that salary provide up to the $100,000 limit is fully includable in the forgiveness calculation. So as it relates to the cash compensation, an owner isn't treated any differently than anybody else. Where the owners get treated differently are on the net cash portions. So any amounts contributed by the company into the owner's retirement plan, any amounts paid by the company for the owner's health insurance, and any amounts for SUTA paid by the employer would have to be excluded from the calculation. So if you think of the cash compensation plus health care, plus the SUTA, plus the retirement, it's only the retirement, health care, and SUTA that are different for employees versus owners. So the cash comp would be the same. It's just those other three that you're capped off as don't have the math memorized yet, but the $100,000 annual that Kate had in the slide earlier, for an owner, you're
as well as capped by what you earned in 2019. So if you earn something less in 2019, you are maxed out at whatever that 2019 amount is.
But have you seen anything as far as bonuses? Right, it seems like the Schedule C verbiage out there does through 2019. If you're an S Corp giving yourself a wage, it seems as though there might be some avenue there to pay yourself a bonus, and kind of bonuses are includable in 52 weeks. I think there's still some ambiguity if you're a W-2 under an S Corp scenario. I think there's a little bit of ambiguity whether bonuses would be included or not. Did your kind of rate of pay from 2019?
I have not seen anything that would allow your wage to exceed what you earned in 2019. But again, more clarity should be coming.
Yep.
If we opt for the 24-week model, do we have to stretch the PPP funds out over 24 weeks, or can we still spend it all in 8 weeks? I suspect if you choose the 24 weeks, you're going to have to submit documentation for 24 weeks. I think that's another item that's going to have to be clarified. You can certainly spend it in less than 24 weeks. And if you think you've got it all used in 8 weeks, maybe you just choose the 8-week period. Is reimbursement for mileage for employees eligible? Some transportation costs are eligible. I don't think a mileage reimbursement would probably not qualify.
This is one where they, oh, go ahead, Mike.
I was going to say, I mean, when you kind of look at how the IRS develops mileage reimbursement, some of it is fuel, which is clearly includable, but a lot of it is really attributable to the wear and tear on the automobile. That would not be includable. So we've had this question before. There's not a specific rule out there. I don't believe it's going to be includable because it really is not specific to just fuel.
Can we apply for another PPP if we've spent the first PPP? Well, there's nothing that changes the application requirements. So you would not qualify for any more money than you've already received the first time. But I haven't seen anything that's changing any of the application requirements. Since the $100,000 cap increases over 24 weeks, many wages to employees that would be capped in 8 weeks will now be eligible. Is this correct? Well, you would adjust the proportionate amount from the 8-week pro rata of $100,000 to 24 weeks. Is that what the question is?
I think so. And yes, you just would increase it. So $100,000 divided by 52 times 24. So 46,154. So that the number that we were talking about before, about 15,000 or so, is now the 46,154.
Would fuel purchase for semi-trucks be included, driven by employees? It says utilities, including transportation. There's not a lot of guidance other than that I've seen.
Yeah, but I do think that the trucking industry at least has taken a position to say, under this scenario where the cost isn't just the mileage reimbursement that includes a multitude of different elements to it, it is pure just fuel. Yes, that would be, at least the transportation industry has taken a position right now that is an includable cost.
Again, subject to change by the SBA at any point in time.
Most likely on Friday nights.
Yes, right.
Well, thank you, everybody. That concludes our webinar. I'd like to thank Kate, Mike, and Sandy for their time and their perspectives today. I'd also like to thank everyone who joined us. Please note the presentation will be sent out to you as soon as possible, along with an updated version of the calculator. Like Kate said, you can also go to our website, and if you're not receiving our WVC Insights, at the top of right-hand corner, there is the option to add to that, to get added to those emails. If you have any questions regarding today's topic, I encourage you to give us a call. We will provide the contact information for the speakers shortly. More webinars are in the works, so please keep your eyes peeled, and again, sign up for those WVC Insights. Thank you, everybody, and have a wonderful afternoon.
Thank you, everybody.
Thanks all.
Bye.